Hey again, everybody. So I'm Ariah Klages-Mundt. I'm a PhD student at Cornell. And I'm going to tell you about instability for the blockchain, deleveraging spirals, and stablecoin attacks. So this is the DeFi Summit. So you've all heard about DeFi. The idea is to build, on top of blockchain, a new financial system that lets us do the same sort of things we could do with the old financial system. So hold complex financial assets, manage complex financial portfolios, and lend out assets to other people. And this has been growing rapidly over the past 2 years, as you can see in the chart here, up to today $500 million in assets locked into these systems. And it's also been growing increasingly complicated. So as you can see here, with all of these different protocols, people are composing the different assets between the protocols. So you may have things on Maker, where you're holding DAI. You may hold that through Compound, which you get CDAI. And then you may hold the CDAI through one of these other protocols as well. And so you're sort of like composing risks on top of each other. And when you have complex financial systems that have these complex features, they usually end up having complex risks. So the best example of this is probably the 2008 financial crisis, where you have some of these assets that are meant to be stabilizing forces in the economy, called credit default swaps. And they actually end up triggering the financial crisis because of a tail event that people thought wouldn't happen. Now, here we're talking about things that are in blockchain and the DeFi sort of space. And so we should ask the question, this is different, right? Because the whole idea of building these systems is to make a better financial system where we don't have these sort of risks. But it turns out that these assets really do have some of these surprising risks because they're complicated contracts. So this is Nubits, one of the first stablecoins. And as you can see, it has some periods of pretty good stability, but then it has some big destabilizing times, and today it's trading at pennies on the dollar. Here's BitUSD, another stablecoin, and it had a depegging last December. Here's Steam Dollars, another stablecoin that's been having trouble keeping its peg over the last year. Here's BitBTC, similar to BitUSD, a synthetic asset that's tracking Bitcoin, and as you can see, it's had a depegging as well. And it's surprising that these sort of events, although the stablecoins and synthetic assets are very popular, these sort of depegging events don't really make it into the news very much. I bet a lot of you probably haven't heard of some of these. The things that do make it into the news, for instance here, Synthetics Oracle attack back in June this summer. Lost roughly 37 million, although notably that was able to be rolled back because their contracts are currently centralized. Then a month later, Terra, another big stablecoin, facing 2 Oracle attacks in the span of a single week. So the problem is that these new systems, there's little formal understanding of how they work. It turns out they have some complex feedback effects. There's also sort of no truly stable asset that's efficiently accessible through these systems, because that's actually what you're trying to build in the first place. When you're operating in the normal financial system, you're able to access something that you can assume is black box stable, like the US dollar. But here, we're trying to create that in the first place. And then they also involve complicated interactions of many agents. And so it's hard to work out exactly how these systems work. And so in this talk, I'm going to run you through a little bit about understanding more about the stablecoin space and sort of highlight some of the differences from traditional currency peg models, why it's not so easy to just apply the existing frameworks to understanding these new systems, and then go over a bit of our recent paper that introduces a new model for understanding these systems and introduces new deleveraging risks in these systems, and also motivates some follow-up work. So, probably a refresher for everybody, but just to set the groundwork, blockchain provides a new way for mistrusting agents to cooperate without the need for like a trusted third party. Ethereum then, on top of that, introduces a new scripting functionality through smart contracts. And the sort of promise of this is that you can combine things about cryptographic security, some elements of privacy, incentive alignment, and reduced counterparty risk to make financial contracts on Ethereum. But there's a trade-off. The price of Ethereum is highly volatile because it's tied to sort of network effects around adoption, further technical progress, and some regulatory hurdles. And so that's where stablecoins come in. So the aim of a stablecoin is to be a protocol that stabilizes the market price or purchasing power, essentially making some sort of system built on top of blockchain that has this extra structure. And the goal is to make a more usable and adoptable cryptocurrency. And so there are two types of stablecoins that people usually mean when you're talking about a stablecoin. The first is a custodial stablecoin, where there's some sort of reserve asset held by a custodian off-chain. So an example is the proposed Libra. And here, you're really reintroducing an idea of counterparty risk that cryptocurrencies were otherwise supposed to solve. And then there's also non-custodial stablecoins, in which you're using some sort of on-chain mechanism to maintain this stable market. And so an example is MakerDAO. And in these systems, you're working in the public blockchain setting, and so any agent can sort of pseudonymously participate, and you can have potentially malicious agents that are attacking the system. You also have sort of a lot of designs in the current space that are all sort of similar and ad hoc, and as we saw earlier, it leads to markets that break down during extreme events. So let's look at the space a little bit more and break it down a little bit further. So we've already broken it down between custodial and non-custodial. So on the custodial side, we have risks around counterparty credit risk and censorship risks, and luckily these are sort of well understood at the moment. And on the other side, we have risks around oracles and governance, smart contract bugs, blockchain consensus risks, and we'll get into these in a little bit more detail, and susceptibility to new attacks. And this side of things is not well understood. What sort of escapes some of the discussion on stablecoins is you can think about the custodial side a little bit in further detail as well. Just going to go over this quickly. So there are two types of custodial stablecoins. One is similar to a bank, in which you have really like less than 100% reserves. And the other is a custodial fund where you have 100% reserves. And so the difference here is that on one side, you're thinking about risks in terms of crisis of confidence risks, which are threshold sort of risks. And on the other side, it's almost like an exchange-traded fund. And then you can break down the bank side a little bit further in terms of like whether the entity is really a custodian, a private custodian, or is like a central bank. And I know China's been talking about making a central bank digital currency recently. And the difference here is that there are sort of existing models to think about all of these then. Bank run models to think about banks, currency attack models to think about central banks, and ETF models to think about the custodial funds. Now when we break down the other side, there are two sort of mechanisms that come up. One is a layer one mechanism. And here, you're really trying to take something that's like Bitcoin and sort of dynamically manipulate some of the facets of it. So this could be sort of like transaction fees, mining rewards, mining time, mining difficulty, and sort of manipulating these in a dynamic way to try to achieve stability. The other is sort of layer two, where you're building something that's more like a risk transfer market as an application on top of a blockchain. And so the difference here is that by directly manipulating the whole layer one, that comes with direct consensus risks. Whereas when you're building this on top of the blockchain, you introduce these market deleveraging risks, which I'm going to go through a little bit further, and these indirect sort of consensus risks. And layer two can be broken down a little bit further in terms of whether it's crypto collateralized, so that's like DAI and BitUSD, or whether it's sort of non-collateralized algorithmically, or really self-collateralized. And the difference here is that sort of the side here, you can think about it in terms of some of the same basic models that we're going to develop, but the self-collateralized side has sort of more amplified feedback effects. And so in this talk, we're really going to be focusing on this layer two area. So specifically targeting these crypto collateralized things to build up our model, but the model can be generalized to think about all of these things in the layer two area. Okay, so let's go through an example of what this looks like. So the most basic thing is a non-custodial contract for difference. And so this involves two agents, a stablecoin holder and a speculator. Let's say they both enter 1 ETH, currently worth $100, into a contract. This is t equals 0. So now there's 2 ETH worth $200 in the contract. And now at t equals 1, a price oracle updates the price of ETH to the contract. Let's say it's now worth $160 for the 2 ETH. And then the contract is settled. And so the stablecoin holder gets back $100, and the remainder goes to the speculator, who bears a loss. But of course, the speculator would have borne a profit if the price had moved the other way, and that's sort of what they're betting on. So this is a little bit similar to a forward contract, except that the price is really only fixed in fiat terms, while the payout is really in some volatile, risky asset. And in these markets, there are big frictions to sort of converting from these risky assets back to fiat. So you can't really make the safe assumption that that's the value you get out. And if you're thinking about this in terms of, would you want to enter into this stablecoin, the question would come up like, how safe are you? When there's a liquidation event, it's not really good for you necessarily, because you would have to, if you want to maintain the stablecoin position, you have to buy back into something similar, and there's no guarantee that that'll be available at a good price. So this has motivated these decentralized stablecoins like DAI that try to get around this by having sort of no set expiration. So these sort of work by having, again, you have a speculator sort of agent. They're locking in here, for example, 1 ETH worth $100, and they create 50 stablecoins against that. And if you want to think in terms of balance sheets, that's here. And then they take these 50 stablecoins, come to a stablecoin market, and sell it for about 0.5 ETH. And here I mean about because it depends really on what the market is willing to bear. And as we'll see, it's quite difficult to work out how these markets will really come to an equilibrium. And there's an idea of sort of like arbitrage here that tries to maintain the market. So the idea is that if the price is too much above or below the target, $1, then the speculators have some sort of incentive to increase or decrease their leverage, which is what they're achieving here, because if they get 0.5 ETH, they really have like a position of 1.5x in ETH. And so now the balance sheet is updated here. And at any time, the speculator can sort of repurchase their 50 stablecoins to unlock their original collateral. And the other side of the market are these stablecoin holders who then buy the stablecoins. And then as time moves forward, the price oracle updates the collateral contract with the new prices. And if the collateral value sort of decreases below some threshold, then there's a partial liquidation that can happen of the speculator's positions through the stablecoin market by buying back stablecoins. And then the system can also be globally settled if it runs into some problems. And in that case, the stablecoin holders are able to exchange their stablecoins at the last oracle price for the ETH collateral, and the speculators can receive the rest. So this is like settling the contract for difference that we were trying to get away from in the first place. And you can sort of see two main areas of potential problems arising here. One is in the price oracle, which could be subject to manipulation, and the other is in the dynamics of this stablecoin market. So sort of recapping on the non-custodial stablecoin risks, there are these smart contract bugs, but there's a lot of work that sort of goes into understanding this already in terms of security auditing and formal verification. And then there are these other risks around sort of the interaction of many agents. And that's around like the risk of market collapse, which we're going to talk about in this paper, and then around oracle and governance manipulation. And so a natural question is, can we just sort of apply some of the existing literature from currency models to understand these settings? And the answer is unfortunately no. So in setting up the original currency peg models, it looks something like this, where you're analyzing a game between sort of multiple currency holders, and then you have a government issuer, which is not really a player in the game, and they're sort of like mechanically committed to stability for its own sake. Whereas in the stablecoin setting, you're really replacing that government issuer with decentralized speculators who become players in the game. And they're sort of issuing and withdrawing stablecoins in order to optimize their long-run profits. And importantly, they're not really committed to maintaining the peg. The best we can sort of hope for in this area is that the protocol itself is well designed and the peg is maintained through the incentives that are set up with some high probability. And so it's a much more complicated setting to think about. And so in this paper, I introduce a model. It's a simple model, but versatile. It's inspired by the paper here by Ammons and Farmer. It's dynamic and able to take into account some of these feedback effects. It involves these two types of agents sort of solving different optimization problems that's consistent with some sort of normal documented behaviors, but can include sort of other behaviors that you can plug in modularly to think about these markets under a variety of settings. It turns out to be tractable enough to run simulations with, and you can add sort of more features later that you want to look at. And it provides the core of this simulation setting that we'll look at later. An important assumption to highlight here is that in this first model, the movement sort of between the blockchain setting and back to fiat is limited to 0. Basically, you're interacting within this blockchain setting. Now, this actually applies to some agents, but of course, in the real world, there is going to be some movement, and so you may see some sort of like damping of the actual effects that the model would show. But the results are still consistent with what we see in actual data. So again, we have these two types of agents. The stablecoin holder, who's choosing some sort of portfolio weights to seek their stability, and the speculator, who's choosing their leverage in a speculative position behind these stablecoins. So they're providing the collateral. And then there are two assets, Ether, which is a risky asset with an exogenous price, and the stablecoin, which I call D-stablecoin for decentralized, which has an endogenous price that we're trying to model through this model. And then there's a stablecoin market that's set up that clears by setting demand equal to supply in the target terms, in this case USD. And this is sort of similar to how the Uniswap DEX works and is related to the quantity theory of money, if that's a familiar term. And so the model works by, in t equals 0, setting up agents with some endowments and prior beliefs, and then for each time period going forward, there's a new Ether price that's revealed. Ether expectations are updated by the agents. Stablecoin holders then decide their portfolio weights. And then the speculator, seeing demand, decides their leverage. And then the stablecoin market is cleared. And the rationale for this ordering is that sophisticated agents are right now able to front-run DEXs where most of these trades actually take place. And so it's sort of reasonable that they could decide the position they want to hold after seeing sort of the demand side of things. And there's also some evidence that demand doesn't really decrease tremendously with price. If you want to see a comical example of that, you can look up Steam dollars a couple of years ago. And then sort of focusing on how the speculator makes his decision, they decide to change the stablecoin supply to maximize their next period expected returns subject to some constraints. So these constraints are twofold here. One is a liquidation constraint, which is inherent to the protocol. So this is saying that they have to be over-collateralized by some certain amount, and the protocol dictates what that amount should be. And then they also face a risk constraint, which they impose on themselves, which is essentially saying how much does a speculator want to avoid liquidation, because liquidations are actually costly. An example of this would be a value at risk constraint, which would be consistent with a margin of safety idea, the idea being that you're going to try to avoid liquidations with a certain probability. But you can plug in a number of other different ways that the speculator makes this constraint, and we consider this throughout the rest of the paper as well. So from this model setup, we're able to derive a few analytical results that tell us about the system, and then also some simulation results. So the first analytical result is that there's a bound to the speculator's ability to maintain the market. And this looks something like the following. Basically, some lower bound on collateral, the difference between that and a measure of capital required to enter the market. This must be sufficiently large or else the system isn't solvable and basically would have to go to global settlement. The second result is that speculators face an inherent limit to how fast they can deleverage their positions, even if they're bringing in new capital to the system. And this leads to what we call a deleveraging spiral, which is where speculators repurchase stablecoins to try to lower their leverage, or because they're forced to through these liquidations, at increasing prices as liquidity is drying up in the market. So let's go through an intuitive idea of how this works. So here on the far side, we're looking at a measure of price in the market. Here, a measure of demand equals supply, so how much of each side is in the market, and in equilibrium it'll be balanced. And then here, looking at the amount of collateral backing the market. So now let's suppose there's a liquidation that happens. So some amount of the supply has to be bought back using the collateral, so both decrease, and this puts an imbalance on the market. And the idea is that the price has to rise, obviously, to compensate, which lowers the demand and puts things back in balance. But now let's look at what happens during a second round of this. If there's a second round of liquidations, then the collateral has to be used to buy back the supply again, but we're already at a higher price, and so more of the collateral has to be used up. And it again goes through the process of putting an equilibrium back to the market. But multiple waves of this uses up more and more collateral because the price has to rise. A natural question is, well, what if you designed it a little bit differently so that this sort of doesn't happen? What happens to the deleveraging problems then? And unfortunately, they still apply here. It just really comes down to who bears the risks. So an example is in this paper by Chow et al. They propose a stablecoin that's restricted to some predefined leverage bounds. And in this case, they're sort of like automated resets that occur if it reaches these bounds that liquidates positions on both sides at face value to reduce leverage. But what's really happening here is that the deleveraging risk is shifting from the speculator to the stablecoin holder. Whereas before, the speculator's collateral would have to buy back at the market price. Now it's buying back at the face value, and essentially the stablecoin holder has to rebuy in if they want to maintain that position at an inflated price afterwards. So basically, the stablecoin holder is liquidated at face value, but if they want to maintain the position, they have to buy back in at market value, which may be higher. And so they also introduced like a PDE valuation method for trying to value this stablecoin, but it can't sort of capture these more complicated feedback effects. Of the many designs that you could come up with, it's not really clear what deleveraging method might lead to something that survives longer. But they all have the same basic problems around deleveraging. The third analytical result is looking at sort of stable versus unstable regions for this stablecoin to operate in. So if we put a couple further assumptions on our model, in this case assuming that stablecoin demand is constant and the expected ether return is also constant, just simplifying assumptions to be able to prove this more easily, then if the leverage constraint of the speculator remains inactive, so it's never sort of binding, then the system converges very quickly to a steady state with a stable value, a stable price, and sort of zero variance. So in this case, the stablecoin design works very well. An important observation, though, is that the steady state may not have a price of $1. It may be less or higher, depending on sort of where the equilibrium ends up. There's then a conjecture that sort of outside of this stable domain, volatility is bounded above zero with high probability. The idea is that outside of this stable area, you're more likely to, if you start outside, you're more likely to remain outside in the next steps because of this feedback deleveraging effect. It leads to something that's like a kink in the probability distribution at the boundary that keeps pushing you further out. So these effects actually are able to explain some of the data from the DAI market. So in this graphic over here, we're looking at sort of the December 2018 DAI market. And as you can see, this line here is showing the, well, it's an analog of the supply. It's actually the market cap. But the supply is decreasing over time here, and the price is sort of leading to an increase. So you could consider this as like an early phase of this deleveraging spiral. And here we're looking at the sort of normal times in the DAI market, late January and February of this past year. And this is showing you sort of like the trading price of DAI. And it's consistently like below the target of $1. And this sort of feeds back into our stable domain result, which predicts that under some circumstances you can actually have this. And under normal circumstances, that's what you might actually expect. And this is what the Maker team is trying to tweak by choosing the right stability fee to sort of balance the market. And another sort of interesting thing to see here is that these spikes are happening from liquidations that occur. And so you're actually seeing some price impacts from these liquidations. Now moving on to some of the simulations that we're able to do. So we're actually able to see these stable and unstable domains in the simulations. And so here, we're looking at sort of like a probability distribution, a histogram of the contributions to volatility, depending on whether these constraints of the speculator are binding or not, whether they're active or inactive. And you're seeing much less contribution to volatility when you're inside that stable sort of area compared to outside. We're also able to look at sort of what the long-term volatility can be in these settings. And in this case, we're looking at it under a number of different speculator decision processes for making that risk constraint. And so what we're looking at here in these different charts is 3 different probability distributions of what ether returns look like. And in each chart, you're looking then at, on the x-axis, the different speculator behaviors that we want to model. And on the y-axis, the daily level of volatility over a long run in these systems. And then what you're seeing for each x entry is an individual histogram of performance of a number of runs, the volatility that you see for the given x value. And then these lines are showing you percentiles in the data. So the blue line is showing you the 70th percentile, red line showing the 95th percentile, and then comparing it to the actual ether volatility. And one of the things that's striking here is that in most cases, these things lead to very low volatility, but in sort of non-trivial probabilities, it actually leads to volatility that can be on the order of actual ether volatility. And so it shouldn't be too surprising if some of these systems fail, which is what we were actually seeing when we started the talk. And another striking thing is that this is sort of consistent across probability distributions. Even if we make very nice assumptions about the distribution, in this case assuming that it's normal, or in this case has very significant positive drift, you're still seeing some of the same problems that can emerge from volatility. We can also look at an idea of when a global settlement might have to be called. So in this case, just kind of defining it as when the liquidation constraint becomes unachievable, in which case that's really the only way to settle the system, or if the price sort of remains consistently too low. Here, just setting it to 50 cents. And then over that, looking at a number of runs and what happens under these different settings as well. So a similar histogram here. And again, one of the striking things is that these things can fail with non-trivial sort of probability. And the consequence is that the survival of these systems really relies on new capital entering the market when there's a big downturn, which is not always guaranteed to happen. So one of the things that can happen from these deleveraging effects is it can lead to potential attacks. One important thing to highlight here is that attacking a stablecoin is kind of a different idea than attacking a traditional currency. The focus is no longer on breaking the willingness of the central bank to maintain a peg. It's now instead sort of targeting manipulated interaction of these speculators that are participating in the system. Some of the attack primitives that I should point out then are that these deleveraging spirals lead to something that's arbitrage-like around these liquidations, trades that you could potentially enter into with low risk. And then further, real implementations of these stablecoins sort of add a true arbitrage to actually like incentivize the triggering of these liquidations, to do it in like an automated sort of way. So DAI has that, Compound has that. And then miners are also in a position to censor and reorder transactions to extract profit for themselves. So the first attack that's possible here is that in an ether decline, an attacker could manipulate the market to try to trigger and profit from spiraling liquidations. This attack is kind of close to a short squeeze-like attack on the existing speculators. And you could try to supplement it as well with a bribe to miners to try to freeze collateral top-ups in the system. So how this would work is first the attacker tries to dry up the stablecoin liquidity sort of before there's a big crash, and then like holds the stablecoin position at lowish sort of prices. And then in an ether decline, they try to trigger the liquidations and earn the spreads that develop. And try to trigger sort of like spiraling liquidations to make these spreads even higher. And this can also have an effect of further depressing ether prices if enough ether is sort of being sold because of these. And then maybe at the end of the day, they decide to enter as a new speculator at very favorable terms to sort of restabilize the system, but they're able to extract extra spreads in that case as well. But this attack also sort of involves a lot of market risk for the attacker. There's another attack that actually minimizes some of these risks. So the idea here with attack 2 is that after an ether decline, the attacker tries to rewrite the blockchain history to trigger and profit from these spiraling liquidations. So the important thing to highlight here is that slight changes in transaction ordering can actually lead to more liquidations and more extractable value for the attacker. And this leads to perverse incentives for miners if these attack rewards can actually be greater than the mining rewards. So let's walk through an example of how this could work. So here you have timeline 1 on the blockchain, and this is what the Oracle price feed looks like. And it so happens that here's what the liquidations look like in this timeline. Now, if the attacker goes back and tries to make a new timeline of what happened, they can directly inherit the Oracle feed because those transactions are already signed, and so they know what the price trajectory is going to be on this new timeline. They can also directly inherit the liquidations, except inserting themselves as the caller of these liquidations. And then they can also censor transactions to make even more liquidations around some of these decline events. And so they can extract potentially a lot of value if these systems are very big. And that's an important thing to highlight. Basically, the security of these systems, as they're currently set up at least, relies on these systems not being hugely successful, which is kind of a weird thing to hope for. So aside from these attacks, we can also highlight some design insights that come from the work. So one important thing is that what should you be focusing on when you're building a design? And here it's suggesting that you should be focusing on sort of widening the stable region and sort of limiting the severity of the unstable region in your design. And there are some specific design considerations that DAI might consider along these lines. So one is that their current fee structures sort of can have the effect of amplifying some of these deleveraging spirals, whereas they could potentially be designed differently if the focus is around sort of making counter-cyclic fees. And so that's something that would be interesting to think about. Also along the line of fee mechanisms, a good fee mechanism could potentially reduce speculator herd behavior, which could lead to massive liquidations. And then there's also potentially a better last resort sort of use of the MKR token, which right now provides like some sort of idea of last resort insurance if in a global settlement, the collateral is not enough to actually cover all of the stablecoins. Instead, it could be used to sort of quell deleveraging spirals. So basically, if a deleveraging spiral looks like it's happening, MKR could be locked up as collateral and new stablecoins issued against that to try to sort of smooth that out. There are also some open questions that then emerge. The first is sort of like looking at an expanded strategy space of these speculators and attackers to sort of more formally look at these attacks and what other attacks might come up. And then also looking at understanding more about these governance and Oracle risks, because that also comes hand in hand with these market risks, and you could see attacks building off of both. Also very important is composability of risks, which right now we can't even really understand the risk behind just one of these protocols. Now imagine composing that risk with the risk from all of these protocols. And so it's a much more difficult problem to understand these composability of risks as well. And eventually, we want to learn how to design more crash-resistant systems. So using the tools that we develop to help figure out what designs work well and what aspects of designs don't work well and the problems with it. So that brings us to the end of the talk. The key takeaways are that the stablecoin collateral can be consumed faster than you might expect because of these deleveraging spirals. And it leads to these arbitrage-like trades around liquidations that can lead to sort of attack incentives and new attack vectors that we should be considering. And this sort of underscores that you really need a really high level of liquidity in a stablecoin in order to weather downturns. And there are a couple more resources you can check out, including a link to the paper. And thanks everyone for coming, and let's open it up for questions. Yeah.
Do you have any thoughts, or have you thought about the multi-collateral DAI? Like, because the coins that it has are very unstable and probably that, I don't know.
Yeah, what I've seen on multi-collateral DAI so far is that you have a couple different crypto assets that will be in there, but they're all, in essence, sort of correlated. And so the question is it going to be drastically different from just having Ether in there, especially because Ether is the one with like the greatest liquidity itself and the greatest sort of like price support itself. What would be more interesting is if you start bringing in like some custodial assets, I guess, because then you're bringing in like sort of very different risks, but those risks need to be very carefully controlled then. But it also like, yeah, it makes a more complicated system that's harder to understand as well.
So it's a bit of a high-level question. As we're forming the new language in the DeFi space, do you think that the whole space needs to be careful about, for example, using a word like de-stablecoin, which might mislead people who don't understand the technicalities, like business people who don't
You mean
understand.
calling it decentralized?
Just like DeFi, I think works really well. But if a business person hears the word de-stable coin, they might feel like, oh, why is it not stable? If that makes sense. Because yeah, it would be they might be misled to think that it's unstable. Like the debates around privacy and public. You know, public is not necessarily, with blockchain, public is not necessarily everything being visible to everyone, transactions being unencrypted.
Yeah, there might be a better name for it, but one of the important things is that they may not be as stable as you think.
Yeah.
But I just named it de-stablecoin to simplify terminology in the paper.
Yep. It was great talk.
Thanks.
So I believe that compound finance is currently in the middle of, and somebody can correct me if I'm wrong, but they're kind of, there's a vote going on to list MKR as one of the potential assets that could be lent and borrowed. And I'm wondering if you're aware of any sort of analyses because it seems like if you can borrow MKR at a relatively low rate, it's an easy way to game the MakerDAO governance system.
Yeah, that could lead to potential like borrowing to sort of influence a vote.
Yeah.
And so you'd want to take a careful consideration of what the borrowing rate should be for that. How much should it cost to buy a vote? It also sort of comes into how Maker should be, like MKR should be priced in order to like combat potential oracle manipulation. Yeah. So right now, if you look at the Maker system, the important things that MKR will do in the future is deciding who should be oracles, and then deciding also who calls global settlement. So in combination, those are two very powerful things. Now, right now, that's not actually given to MKR holders. It's given to a multi-sig of the Maker Foundation. But when MKR holders actually have that ability, then basically there should be some like balancing of how much it costs to actually do that sort of attack compared to how much it would cost to buy the MKR to do it.
And then it's kind of up to Compound too, in some ways, right?
Yeah, because Compound at this point is manually basically deciding what the interest rates are. Yeah. And so deciding how much it would cost to borrow the MKR. Any other questions? Well, feel free to talk to me afterward as well.